Okay, so hello everyone. Welcome to this kind of preview of the CPI tomorrow and also the Federal Reserve meeting, the FOMC meeting. Just for the record, all of that is happening, of course, on Wednesday, June the 12th, which is tomorrow. I'm recording this on Tuesday, June the 11th. 2024 at about 4:30 p.m. So it's quite a complex situation here, guys. So I'm going to try and keep this relatively short and get through a bunch of different things. So the first thing we have, let's go straight to the CPI numbers. So of course, what the market wants to know is, is disinflation a continuing trend down towards the Fed's target, or are we at a sticky level where things are sort of not too bad and maybe drifting downwards, or maybe the third scenario that things are actually starting to pick up again and getting a little bit worse. So what is interesting is just to see what I might do actually is to sort of first of all just look at inflation expectations. And I should have brought this up before, but I'll try and do it quickly. And just to see where the market is inflation swaps. So this is what the market has been looking at for in inflation, where the market thinks inflation should be priced. And what you guys can see here, this on a daily chart. And what I've got here is all of the inflation swaps from the 1 going all the way out to the 30-year tenor. And essentially what you can see is that, in sort of, October, November, December last year, the market was pricing in inflation expectations to be going down a bit. Then it started going up a little bit out of control in the first part of this year. And since then, it's kind of started to drift down a little bit. So really what the Fed wants to see is this going down more towards again, this is not the CPI or the core PCE. This is where the market believes inflation will be. But I think it's important in terms of trading. And what the market wants to see is inflation sort of going down a bit more. And the Fed wants to see this going down more towards the 2.2 and even converging down to the 2% in terms of what they expect going future. So what the market doesn't want to see is this idea of inflation going up a little bit. So that's kind of where we are. But in terms of tomorrow, we're going to get an update on that. So let's immediately just see what's expected. The first thing I'd say in simple terms is, let's keep it focused on the month-over-month number, which is the most relevant one. So if we just look at the headline month-over-month, it is expected to moderate from 0.3 down to 0.1. So the first thing to keep in mind is that the market, and I guess the Fed, is expecting a moderation. So anything above that would be an unpleasant surprise. On the other hand, if we go to the excluding food and energy, so the core number, that is expected to stay stable. So that's going to be a more important number and possibly a little bit more volatile. So let's just immediately see what the market sort of expectations are for that. You can see there's a bit of a plateau here, so a lot of sort of consensus here. The low estimate 0.2, high estimate 0.3. Average at 0.28. Of course, this is a rounded number, so it's going to be interesting as always to look at the 2 decimal points. But basically, the thing, for the 68 sort of economists surveyed, most people are not really expecting anything higher than 0.3. And as you can see, that the high estimate is in fact 0.3. So the point to make about this for the core number is that if this were to go at 0.4, that would be taken very hawkishly. On the other hand, 0.2, of course, would be good news. If we look at the headline number, let's just see what the range there is. So again, you see a pretty tight spread. You see, it's quite unusual to have such a sort of a plateau kind of effect here. So 0.1, 0.2. So all in all, what the market is expecting is that the headline number is to come in a little bit. Anything above 0.1 would be considered a bit hawkish. And of course, anything above 0.3 in the 0.4 would be sort of hawkish for the ex-food and energy, for the core number, essentially. So the first thing to say is that when we get these numbers, obviously, I think it's going to be fairly binary. If it's going to be higher than expected or lower than expected or in line. In line, I think would be sort of quite welcomed by the market, but I think really where the market would benefit would be something a little bit lower than expected in the excluding in the core number. Now, what's going to be interesting tomorrow, of course, is that we do have the Fed on the same day as the CPI, 5 or 6 hours later. And what a lot of people are saying is that they expect the Fed members to be looking at this data and to extrapolate from this data really where their projections will be going forward. So the real question is, will the market essentially try and front run the Fed and look at the data from the CPI and essentially say, well, that's going to determine the dot plot, the summary of economic projections, and also what the Fed has to say, Powell has to say in his press conference. Okay, so let's just now also look and just see what the market is pricing in for, the Fed funds rate towards the end of the year. So this is just using the futures, pretty similar to the overnight interest rate swaps. But what we're sort of seeing here is that tomorrow, first of all, nothing is priced in. So obviously, if the Fed were to cut tomorrow, that would be a massive, massive shock, but completely unexpected. Where I find it a little bit more interesting is that for July, there are only 2 basis points priced in of a cut. So essentially, let's call it zero. Is that a zero chance? I think probably yes, but who knows? I mean, the Fed, in my humble opinion, if you're looking forward, you've got to say that the meeting in November is right just after the US election, and it'd be, for me, highly doubtful that the Fed would want to cut or do anything just around that point. So that means that the Fed, essentially, if they do want to get in some kind of cut, and it could be a hawkish cut, and let's keep in mind that we had the Bank of Canada doing a cut the other day, a neutral cut. We also had from the ECB last week, we had a cut, but a very hawkish cut. Maybe the Fed wants to get in a hawkish cut. They could cut and say signal that that was not necessarily the beginning of an aggressive cutting cycle. They could also signal that there was completely data dependent. So if we exclude, let's say, something around the US election, which is probably politically too sensitive, that means that either they could do nothing and maybe get one cut in by the end of the year, just before Christmas on the 18th, or it essentially means July. But again, July, we just had, strong payroll numbers last Friday. So it seems to me that, maybe they're a bit uncomfortable. If they did want to get in 2 cuts, it would probably have to be, their only possibility is probably going to be September. But be that as it is, at the moment, what the market is pricing in is about 40 basis points worth of cuts. So it had been as dovish as two cuts about 2-3 weeks ago, and at certain points it had been as hawkish as only 25. So the market has been fluctuating over the last couple of months between only 1 cut and 2 cuts, so between 1 and 2. And as you can see at the moment, as we speak, as I say, as we record this, it's about 1.5 cuts. So really tomorrow we're going to get a little bit more sort of flavor on that. So let's now look and see just where the Fed has been a couple of months ago. So we'll just go back. I think I've got that up somewhere. Yeah, okay. So as you guys know, they only release the summary of economic projections every second meeting. Tomorrow we get fresh and updated ones. So what's super important here is to understand, first of all, these numbers here. For those of you a bit newer, these numbers here are rounded numbers. So the first thing to keep in mind is that the Fed obviously has a target range of 25 basis points. Currently, we're at 525 to 550. So there's a target range 525 to 550. So what's in the middle, we're technically at the moment of an effective Fed funds rate of 5.33. But the thing is that these numbers here, so technically at the moment, the mid-range would be 537.5, which is 12.5 basis points. So imagine there's a 25 basis point range, so 12.5 would represent sort of the mid-rate. And then what happens is that the Fed takes these mid-rates and then rounds it up or down. That's why we get these slightly strange numbers here. But essentially what we can see is that at the last summary of economic projections here, by the end of 2024, the Fed was basically saying that they estimated a number of 4.6, which is essentially the rounded number of 462.5. Now, 462.5 basis points, of course, is the halfway point between 450 and 475. Now, if we're currently at 525 to 550, what this number implies, to keep it very simple here, is 3 cuts. So 4.6 is what the Fed said last time, a couple of months ago. They said, we expect to be cutting 3 times in 2024. But as you guys can see, what the market is essentially saying is maybe once, maybe twice, between 1.5 to 2 times, to 2 cuts, okay? So the first thing to keep in mind is this number here is going to be extremely important here, the 4.6. Now, I've been doing quite a lot of research. It seems to me that what is a probable number here would be the Fed. I think to say no cuts would be extremely hawkish. That's the Fed saying that absolutely no cuts would be extremely hawkish. I think 1 cut is a possibility, but again, I think that's a bit on the aggressive side, although I think it is a possibility. It really depends how the CPI comes out. And that's why I think it's going to be interesting, because if the CPI comes in hotter than expected or higher than expected, I think we could potentially get a number of only sort of one cut, which would basically be 5.1. But I think what's probably going to be a consensus here is two cuts. So the Fed will remove one cut, and they will actually move this number from 4.6 up to 4.9, which would signal a potential for two cuts, which is a little more dovish than where the market is priced at the moment. Again, this kind of consensus view could be dependent on the CPI in the morning. And that's why tomorrow is going to be a little bit complicated. But personally, I'm going to take as a base case, this number being moved up a little hawkishly. The Fed will remove formally their projection of up to 4.9, which essentially would be technically 487.5 basis points. So that's going to be my base case. Okay, so then if we go out to, what I can tell you is that from the research I've been doing, reading quite a lot of stuff today and yesterday, the market consensus in terms of what the bank analysts, the major banks on the street are saying, is agreeing with that, is to say that, a consensus of two cuts is, about sort of 80% the consensus. There are some banks saying only one cut, which, as I say, would be a number here of 5.1. So if you see 5.1, that's going to be very much on the hawkish side. 4.9 is probably consensus at this point. If they leave it unchanged at 4.6, of course, that signals their desire to still do three cuts, which would be extremely dovish. So 4.6 unchanged, extremely dovish. 4.9, a little hawkish, would be, I would say, consensus. And I would say anything above that 5.1 would be very much on the hawkish side. So that's probably the key number to be looking at. Now, of course, we also then want to say, well, okay, what about 2025? And again, what you can see is that a couple of months ago, the Fed was saying, hey, well, after we cut 3 times in 24, we expect that over the course of 2025, we'll go down another 75 basis points with a rounded number of 3.9. So essentially what the Fed was saying is 3 cuts in 24, and then a further 3 cuts for a total of 6 cuts or 150 basis points over this 2-year period. Now, I think as well, the market, from what I've been seeing, the consensus here is maybe to possibly unchanged. And this is where it gets kind of interesting, because essentially you have to be looking at the number of cuts here. So if you say they have 2 cuts penciled in for 24, do they pencil in 3 cuts or another 4 cuts for 2025? And that's going to be pretty interesting here, because if they go to, let's say, 4.9 and they have 3 cuts, that this number here will go up to 4.1. But if it goes up to, if they still want to be a bit more dovish, they could technically keep that unchanged at 3.9, which would be on the dovish side. So what I'm trying to say here is that it's going to be very important to sort of add these up. Now, then the other number, which is going to be very important as well, is going to be the longer run. Now, as you guys can see in the last summary of economic projections here, they did put that up by 0.1%. Now, keep in mind what this number is trying to tell us. This number is trying to tell us that the Fed says, well, in theory, on paper, the inflation target is still around about 2% over time, the core PCE. So this number is like the longer run. What they're trying to say here is that the neutral rate, the so-called R star, the rate at which the Fed funds rate is neither restricting the economy and slowing down economic activity, nor is it being accommodative and sort of helping and boosting the economy. They're saying it's about 60 basis points or 0.6 above inflation. So this is where it gets pretty interesting, because a lot of people are saying that, because of the Ukraine war, because of the onshoring, because of less efficient supply chains, because of a stronger than expected US sort of employment situation and a US economy, that it's not realistic to have a longer run neutral rate at 2.6. And this number should really be at 2.9 or 3 or even over 3. And so, again, it's going to be interesting, let's just say that at a minimum, to see if the Fed tomorrow revises this upwards. In theory, that should be a little bit hawkish. If they put that up to, 2.8, 2.9, 3%, that would be hawkish, especially for the long end, because essentially what that's saying is that the restrictive rate, or R star, needs to be raised a little bit, and basically saying that probably the neutral rate needs to go up. And what that's saying is that the Fed, in a certain sense, is like a tacit sort of admittance that inflation is probably going to be a little stickier, a little bit higher, and that the economy is going to be running a little bit, sort of structurally hotter over the next few years, or as they like to call it, the longer rate. So the thing is, you need to, first of all, be looking at these numbers And as I say, the market consensus here is probably just to take out one cut. So that would be, up to 4.9. And then it's a question of the difference between 4.9 is that do they keep in, 3 cuts or 4 cuts? And again, just to reiterate, if they do go to 4.9, 3 cuts would be 4.1 here, and 4 cuts would be 3.9. So 3.9 would be very dovish. 4.1 would be, I would say, maybe a consensus, 3 to 4 cuts. That's going to be pretty interesting. And just on that point, though, if you want to look at the end of 2025, what we can do, a way to get a sort of a sense of that, is just to look at where the SOFR contracts are trading. So this is the December 2025 on the short-term futures contracts. What you guys can see here is that this is where we're trading at the moment. This is a daily chart. We're trading just under this blue line, and this blue line here is essentially, I've calculated it at 95.920. If you factor in the implied yield, that is basically saying from now about 125 basis points of cuts over the next period until December 25. So that would be 5 in total. Okay. Oh, so that's 6, 5 in total. So what you can see is that going down here would be only 4 cuts. So it's a little bit more hawkish. And this is 5 cuts. So it's pretty simple. If you start to look at that sort of that number by the end of 2025, if the Fed is only pricing in the 5 cuts or 125 basis points, we can expect this number to be around here. On the other hand, if it's a bit more hawkish, we can expect this the December futures contracts to drop down here to 100 basis points, which is only 4 cuts. Okay, so what you need to be doing is to be looking at those dot plot projections. And for example, this could be a possible trading instrument, although of course the algo is going to move pretty hard and fast. But just keep in mind with this one, of course, the way to do this is to take the number of 100 as a base. You subtract this price here. That will give you a number. And then you have to subtract that from the current effective Fed funds rate, which is currently at about 5.33. And that will give you what's implied. So that's the way to look at that. Okay, so if we keep on looking at the summary of economic projections, which is here. The next thing to be looking at, of course, is how the Fed is feeling about where the economy is going, where the inflation rate is going. So the first thing, I wouldn't bother with the headline inflation, but looking at the core PCE. Now, as you guys can see, in the last SEP here, they did revise the projections for core PCE for the end of this year up 0.2. So, and then of course you can see in 25 they kept it unchanged, and also for 2026. So essentially what they said is like, okay, it might get a little stickier in 2024, but they do expect it slowly in 25 and 2026 to come back down to their target of 2%. So what's going to be very interesting tomorrow is whether to see all of this is unchanged, or stays at 2.6, 2.2, and 2.0, or whether the Fed, who knows, is going to be a little bit more optimistic. And let's say, for example, revise the 2.6 down to 2.5, keep it unchanged. Or what would be hawkish, of course, if they revise this upwards to 2.7 or 2.8. We also want to see the long-term projection or the medium-term projection and see where that's going. So the next number you need to be looking at is the core PCE, just to see where they're thinking. Excuse me, a lot of talking. Okay, the next thing to be looking at, of course, is just their views on where the economy is going. Personally, the next one I'll be looking at for is the change in real GDP, which is, sort of their views on growth. And what we can see here is that last time around, they substantially revised it upwards from 1.4 to 2.1. That was a pretty significant upgrade. And then they saw economic activity, slowing slightly or slowly over 2025-26. It's going to be interesting whether this is revised downwards, so less than 2.1. Is the Fed, so the point here is that the market wants to know if the Fed's thinking that there is some evidence of a cooling in the economy, personal spending, the jobs report, all this kind of stuff. Like, how does the Fed feel the US economy is going? And of course, the lower this number is, that would seem to indicate less inflationary pressures and would be essentially a little bit dovish. You need to be looking at this number in conjunction with the unemployment rate, which, as you can see, they revised it downwards, which is saying a stronger labor market, last time. Let's see what they have to say tomorrow. If this number goes up back to 4.1, 4.2, 4.3, that of course means that the Fed thinks that the employment situation is worsening, which, all things considered should be deflationary in a certain sense. But of course, we had the non-farm payrolls number last Friday, which was a little bit ambiguous because the headline establishment survey was very, very strong, 275,000, whereas the unemployment rate itself was ticking up a little bit. So again, need to be looking at all of these numbers to get their views of where the economy is going, where they think inflation, whether they're making progress, and of course, how they see all their Fed funds rate. Now, keep in mind that the Fed funds rate here is the median of the 17 members, and it just takes one or two members to change their dots. So this is a very delicate number, but hey, all we can do is to look at that. So that's that. Now, the other thing, as I say, is that the CPI numbers coming out at 8:30, because of course these numbers come out, was that 5.5 hours later? Is it 4.5 hours later, 5.5 hours later at 2 p.m.? And it's reasonable to suspect that, committee members on the FOMC will quite possibly not pencil in all of their data until they see the CPI numbers. And it's also reasonable to expect, I believe, that the market might try and, as I say, sort of front run the FOMC meeting. Maybe not everyone. We'll talk about it in a second. Okay. The other thing to talk about is the statement. We'll get an updated statement tomorrow. I've just highlighted here what I think will be the main areas to look at. First of all, in the first paragraph, again, this will reflect a little bit the numbers we see in the summary of economic projections. I just want to see what they think about recent economic activity. Are they going to say it's continued to expand at a solid pace, or will they say that, the growth has moderated or has slowed? Let's just see what they have to say there. The job gains have remained strong and the unemployment rate has remained low. Do they talk about the unemployment rate as maybe ticking up? Do they say that job gains have moderated? So again, a little bit more of color and flavor about that. And then, of course, the big one is inflation. The last statement here from a month ago or 6 weeks ago was inflation has eased over the past year, but remains elevated. Do they say that it has, remained sort of flat and stagnated? There's been a lack of further progress. Do they say there's been more progress, or, a lack of further progress? So very interesting to see there. Personally, I don't see a huge amount in the second paragraph. I think that's sort of pretty boilerplate. For me, the key thing is also going to be down here in the third paragraph. The committee does not expect it will be appropriate to reduce the target range. Okay, we want to know when. When do they think it's going to be appropriate to reduce the target range? Until it has gained further confidence. Now, Powell has talked about needing more confidence. He talked 3 or 4 months ago about having a bit more confidence that they're on the right track. And then, of course, over the last, a couple of months or so, he said that they've had less confidence that they're on the right track. So it basically, let's see what they have to say until it has gained greater confidence. Will they say it has gained greater confidence, or has less confidence, or is still looking for more confidence that inflation is moving sustainably towards the target? So this is going to be very key, just the wording there. I can't see particularly too much else there, which is going to be of a huge amount of interest. Now, of course, all of this happens at 2 p.m. So at this point, the market will have absorbed the CPI at 8:30. We will have absorbed the forward projections. It's going to be a lot of volatility. What is going to be interesting for me, and this is where I think it's going to get interesting and maybe a little bit complicated and probably quite volatile, is that the CPI could be extremely directional. Let's say, for example, let's take an example and say the CPI actually comes in hotter than expected. Let's say, for example, that the Fed on the summary of economic projections projects a relatively strong economy, an unemployment rate which remains pretty low, not a huge amount of progress on inflation, and let's say the dot plot is revised up a little bit hawkishly, so maybe not removing one cut, but maybe removing 2 cuts, and then 2025 and 2026 even removing some cuts there. That's going to be very, very hawkish. And of course, what we're going to see, probably the stocks come off. We're going to see the short end of the curve come off. We're going to see gold probably come off pretty hard. We're going to see the dollar probably rally, the euro come down, all pretty classical reactions. What's then going to be interesting and vice versa on the dovish side of things. So of course, if we see the opposite and we see that, the core inflation comes in lower than expected and the headline comes in low as expected, and we see that the Fed seems reasonably happy with the progress and everything going towards their inflation target, and we see that the dot plot, maybe, for example, they take out just one cut for 2024, and maybe in 2025 they keep it as it was with 3 cuts, or who knows, maybe they can even add a cut and say, well, we'll take out one for 24, but add in a 4th cut for 2025. Then the market might take this in a pretty dovish way, and we're going to see the exact opposite. We'll see gold maybe rallying. We'll see maybe the yields coming down. We might see the bonds having a rally. We might see the US dollar coming off. We might see a big sort of rally in the stock market. What's going to be interesting is how is Powell going to deal with all of this? And again, I think if all of the data, well, the data from the CPI is pretty directional and clear and strong, or directional and lower than expected and dovish, I think that makes the job of Powell at the press conference relatively easy. And he can simply point to the data and say, on a hawkish sense, he can say, well, we don't have as much confidence, therefore we're going to be data dependent. We still think, believe that we will achieve our target, but it's taking a bit longer than we expect. We need to, maybe not hike interest rates, but we need to sort of stay, at this elevated level for longer. Great. On the other hand, of course, in a dovish situation, it's going to make it relatively easy for Powell to say that, they're regaining slowly a little bit more confidence. One dovish CPI does not mean that they, one swallow does not a summer make. But nonetheless, they do believe that they're getting slower, they're getting closer towards achieving their target, et cetera, et cetera, et cetera. So what is going to be interesting, though, is if the CPI comes in a little bit contradictory, well, it just comes in a little bit contradictory. Now, what do I mean by contradictory? And I think this is where it's going to get interesting. Contradictory could be something that, let me just go back to this. So let's say, for example, we get the month-over-month number, let's say, for example, comes in, at maybe 0.2, so a little bit higher than expectations, but maybe a bit lower than previous. And then let's say the core number month over month comes in at 0.3. Do we sort of take the half as glass full and say, well, at least they're making a bit of progress in the headline number? Or do we say that it's not nearly enough and that the core is still on an annualized basis, 3.6, 12 times 0.3. On the other hand, let's say, for example, the core number comes in at, I don't know, 0.3, but maybe the CPI or 0.2, and this one comes in at 0.3, or you see what I'm saying, a mixed number. Then I think it's going to be pretty interesting to see whether Powell at the press conference, he could be kind of the deal breaker or the casting vote, and he could maybe put his weight behind either a dovish scenario or a bit more of a hawkish scenario. So if the numbers come in with the CPI, it's a little bit ambiguous or not clear, then I think the market is going to put a greater emphasis probably actually on the dots, because we can assume that what goes on the dots and the summary of economic projections will be a little bit what the committee is thinking, and by implication also maybe a little bit what Powell is kind of pushing for. So for sure, I think that if the CPI data comes in an ambiguous or sort of slightly offsetting or contradictory way, definitely the market will possibly wait a little longer and will react more to the dots. And then, of course, it's going to seek confirmation of the SEP and the dots in Powell's press conference. So there could be a lot of volatility. I think obviously the easiest trades are going to be the trades which are going to be directional. By which I mean, clearly sort of hawkish or clearly dovish. And I think the point there is to sort of start looking at a few charts and saying, well, okay, where could we go? So you could look, let's say, for example, like December 25 SOFR contracts and say, well, okay, at least they'll probably cut, a little bit over the next sort of 18 months. So in 2025, that's going to give us some kind of base. So you can say, let's say, for example, it gets down here to this blue number, that's at least saying, well, that's going to be 4 cuts. So that implies at least 4 cuts over the next year, which I think is plausible. So that could be a downside target there. It could be a good sort of, target, or even to start dipping your toe in. I certainly think if the December SOFRs get all the way down here, to say that they'll only be cutting 3 times until the end of December 25. You've got to say that's extremely hawkish, and I would say probably a low probability. So, I mean, not that it's going to move that much tomorrow, because that would be a huge, huge move. But at some point in the future, that would certainly be a low. On the other hand, if the data comes in a little bit ambiguous, it's kind of not too hot, not too cold, and this market rallies, let's say all the way up here, you've got to say, well, maybe that's getting a little bit too dovish at that point. Of course, at that point, you'd be looking at 6 cuts, would be 150 basis points. So I think the way to be looking at this is two ways. Is that if it's clearly hawkish or dovish, you could maybe seek confirmation. Sorry, if the CPI data, I mean, is hawkish or dovish, the trade there is to say, well, is there going to be a second push? What are the markets where there is room for things to really move in one more direction? And then you're going to be seeking confirmation for that second push with the summary of economic projections and the 2 p.m. kind of data, and then, of course, at the press conference. And I think there is a possibility here that there could be like some structural repricing on a clearly dovish or a clearly hawkish number. And at that point, you maybe sort of look at things like the dollar index and go, well, okay, the dollar's kind of breaking out here. It had a nice fib retracement here. It's kind of breaking out of the uptrend on extremely hawkish CPI confirmed by a hawkish summary of economic projections and statement and Powell. You go, well, okay, maybe structurally the dollar could push itself up, especially with a bit of risk off towards the European bond market, could push itself all the way up to here over the next, sort of week or two. On the other hand, conversely, you could say that, maybe the dollar, it's time to just go and retest the lows here. Now, in terms of the yields, let's look at the front end. What I would say here is that the 2-year yield, I think this is kind of going to be capped, because anywhere above, as I've mentioned in other videos, anywhere above, let's say 5.08, 5.10, is kind of getting to the point mathematically where the market is saying that the Fed will not cut really at all, almost, over the next 18 months, which seems to be extremely low probability. So I think on a hawkish number, for sure, it could maybe push up towards here. But at that point, it could be an interesting entry point. On the other hand, you've got to say that, if the yields go down and, unless the data is extraordinarily dovish, because the point is that even if we do get some dovish data tomorrow, the Fed will probably say, Powell will probably say, okay, guys, this is nice, but I want to see another data point or two before I can start thinking about cutting. So I think, the market's not going to get too carried away and, drop the yields all the way down here. So I think, that could be sort of a kind of a range. So I do believe the 2 is going to range trade. What's going to be interesting for me is the curve, because if we think that the front end of the curve, they're not going to hike unless we have extraordinarily, a series, 2, 3, 4 extremely hot prints, which seems unlikely. So the probability of hiking, I'd say, is negligible. So at that point, it's a question of, okay, when will they start cutting? And you've got to say the front end of the curve possibly could be less volatile. So therefore, the pressure, it could be taken by the back end of the curve. And what's going to be also interesting, and I want to bring up something which I saw on some research by Damp Spring Report, which is got some great stuff. So Damp Spring Report, and this is their sort of scenario analysis. And this is kind of interesting here, what Andy Constant from Damp Spring Report, and thanks to him, this courtesy of this is his base case scenario here. But what is kind of interesting here, he's got next day or two, is this idea of that if the Fed is relatively sort of dovish, he's saying there's a scenario where you could have, let's say, if the S&P is unchanged from the most recent one, the Dove, so they don't really change the dots, that would be a buy for all assets, bonds, stocks, etc. But he's saying the next day or two, it could be a sell for the long bonds. When he says bonds here, it's like the long bonds. And also, if they just take out one cut for 24 and 25 remains unchanged, it would be a sell. So why would that be? It could be that the first knee-jerk reaction would be to say, oh, that's kind of dovish, that's great, let's buy all the US treasuries. But at the end of the day, if the market believes that inflation is relatively sticky and that the Fed is not being aggressive enough in fighting inflation, we could get, by analogy, a situation where the doctor, which is the Fed, is looking at the patient, who is still a bit feverish, and not prescribing the hard medicine, the hard drugs necessary. So it could be that, after initial knee-jerk up, the market might say, well, hold on, okay, this is not bad for the front end of the curve, but the back end of the curve, if inflation is not being attacked enough, it means that the economy growth could still run a little hot. Inflation could remain sticky. And ultimately, that is not great news for the long end of the curve, which is why Dan Spring report here is basically saying that, over the next 36 or 48 hours, the long end of the curve could actually start to kind of weaken in relationship to the front end of the curve. So we could get a long end led kind of steepener, bear steepener at that point, which is kind of interesting. Of course, again, just using this sort of as kind of matrix here, which I think is pretty good. Again, what would be the most aggressive one for all assets, bonds, stocks, everything to have an initial move here would of course be the scenario where the 2024 dot plot is revised to 5.1. So again, that's basically taking out 2 cuts and saying there's only going to be 1 more cut. And then the 25 dots would go to 4.1. So essentially that's basically taking out a cut as well. So that'd be taking out 3 cuts over that 18-month period here. And the longer run, of course, being revised up from 2.6 to 2.8. So, again, that would most probably be a pretty sharp sell-off in all bonds right across the curve. Stocks, NASDAQ, I think the Russell would hate that, absolutely. All assets probably going to see the gold falling off, the precious metals, a bunch of stuff. And then, but what is interesting, conversely, is that if the Fed is particularly hawkish in their signaling and communication, that aggressive medicine would act in the opposite way, and that the market after 24, 36 hours might look at the long bonds then, like the 30-year or the TLT, and say, well, actually, all things considered, at least the Fed is being active in the fight against inflation, and ultimately that could slow down the economy and growth and ultimately get inflation under control, which ultimately is not great for the long bonds, but it's sort of neutral. So at that point, you may want to consider some kind of flattener trade there. So long end led kind of flattener at that point there. But just by the way, that's the base case here, 4.9, a little bit what I outlined this, before, which essentially says that they remove, the number goes from 4.6 to 4.9. They remove 1 cut just to signal a little bit of hawkishness. And then for the 2025, they basically remove 1 cut as well, which is possible. So instead of having 6, it would go down to 4. I don't know about that. I think really there's a possibility that it goes 4.9 to 3.9. So I think this one is possible. So that there's still 3 cuts for 2025. So I think really for me, the key is just going to be this little combination here. And of course, we have to look at the longer run. And now in that situation there, we'll see. So that's about it, guys. I think I'll leave it there because we could go on a lot more. But again, I think the thing to do is, first of all, to look at the CPI data. First of all, try and establish whether this is extremely directional or whether it's as expected or contradictory. I think if it's a directional, one could assume that the market might start to price in some kind of second push between 8:30 and 2 p.m. Some people are saying that no, the really big players, maybe they want to wait until 2 p.m. or even after Powell finishes speaking at around about 3:10. And then there could be sort of conferences, and then like the really big money could have a push into the Asia Pacific session and then the overnight session. And again, if we get a feeling that structural, like the market needs to be structurally repriced, it could be these kind of moves sometimes could go for 24, 36 hours, could even go overnight European session, maybe even into the US session tomorrow. And of course, on the Thursday, the day after, and keep in mind that on the Thursday, we do have PPI, which I think is going to be secondary at this point, unless of course the PPI contradicts or kind of reinforces and validates what we get in the CPI. So that's that. On the other hand, if the CPI data tomorrow morning is sort of a little bit in line and contradictory, I think possibly the smartest trade would be just to wait for the SEP and all the data at 2 p.m. And even then, maybe to wait and see what Powell has to say, because it's got to be pretty choppy. Personally, I have a long volatility play on, which was a little bit expensive for the implied vol. So personally, I'm just hoping for some volatility either way. Over the course of tomorrow, I have an expiry on Friday. Anyway, that's we'll see how that goes. And that's it. So hopefully that was useful, and good luck, and take your time because it's going to be a lot of choppiness tomorrow. Wait for excellent entry points. All right. Thank you. and good afternoon.